In today's video, we're going to go over some of the pros and cons of an adjustable rate mortgage, also known as an ARM. And we're going to get started right now. Hi, my name is David Matney with Nebraska Realty. I'm a local realtor here in Omaha, Nebraska. Now let's jump into today's topic. Now, what is an adjustable rate mortgage or an ARM? Now, many people are familiar with a fixed rate mortgage. Now, with a fixed rate mortgage, your interest rate is fixed for the entire length of the mortgage. Now, in the past several years, with fixed rate mortgages being so low, you didn't really see a lot of ARMs because people could lock in a low fixed rate mortgage at 3% for 30 years. Okay, now that interest rates have increased, you're starting to see more and more ARM loans being offered. Now, an ARM loan is where the interest rate can change or adjust throughout the period of the loan. So why would anyone want to do an ARM loan? Now, here's the thing with ARM loans. They're kind of like ice cream. They come in all different flavors. And some common ARM loans are 5-1, 7-1, 10-1. You might see a 5-6 or a 7-6 or a 10-6. Now, what do these numbers mean? Now, the first number tells you the length of time that your initial interest rate is fixed. For example, in our example of a 10-1 ARM at 4%, for the first 10 years of the life of the loan, your interest rate is fixed at 4%. The second number tells you how often the rate changes after that. So every year following that, your interest rate may adjust, whether it be up or down. Okay, what are some of the pros of an ARM loan? The first pro is that your initial interest rate may be lower than a fixed rate mortgage. Okay, the second pro is that the buyer may be able to qualify for more homes. So the buyer may have more purchasing power with an ARM loan. Okay, now this is another pro, but you got to be very careful with this. Now, if you think or believe that rates will come down, you may be able to refinance at a later time into a fixed rate mortgage at a lower rate. But here's the key thing, and that is if. And then the other key thing that you want to do is if you're doing an ARM loan is you want to make sure that you ask the lender if there's any prepayment penalties. Okay, and this is another big pro with an ARM loan. Let's say you're doing a 10-1 ARM. And you plan on only being in the home for, let's say, 7 years, and then you're moving out of state. Well, if you do a 10-1 ARM at 4%, then that's going to allow you to save money because you plan on moving within 7 years before that initial interest rate changes. So that's one of the pros with an adjustable rate mortgage. Okay, what are some of the cons of an ARM loan? Okay, number one, and this is big, there's more risk involved. And it's very important that you know and understand the risk involved with an adjustable rate mortgage. Okay, the second con of an adjustable rate mortgage is you don't know what your future payment is going to be. This is another con with an adjustable rate mortgage. What if in the future your home decreases in value and then you're not able to refinance the home? Or let's say your financial situation changes and you can't qualify in order to refinance to a lower rate. There is a significant risk involved with that. Okay, the fourth con is let's say the ARM loan adjusts and you can't afford the new payment. Then you could lose your home to foreclosure. If you're going to do an ARM loan, it's important that you have a frank discussion with your trusted mortgage advisor and go over all of the pros and cons to an ARM loan for your particular situation. For some folks, an ARM loan may be great because let's say they're going to sell within a short period of time. In that situation, then an ARM loan might be a good fit. Here's another pro, or you want to make sure of, and that you're confident that you can afford the increases in your monthly payment, even to the maximum amount, if the rate should adjust. Because the rate is going to adjust. You want to make sure that you understand that and that you can afford the loan even at the maximum rate. Okay, how do they determine the interest rate on an adjustable rate mortgage? Now, there's two parts on the interest rate. There is the index and the margin. Okay, the index is a measure of interest rates, generally reflects trends in the overall economy, and different lenders use different indexes for their ARM programs. For example, some lenders are going to use the LIBOR index, LIBOR stands for London Interbank Offered Rate, or they might use the SOFR, which is the Secured Overnight Financing Rate. So you want to ask your lender what index your ARM loan is based on. Okay, the second part of the interest rate is going to be the margin. The margin is an extra percentage that the lender adds to the index. Now you can shop around so you can find the lowest combination of the index plus the margin. Okay, for example, let's say the SOFR index was at 0.5% and the margin was 3.5%. Well, then your total interest rate would be 4%. Now, how high can it go? You want to pay attention to this because there's what they call caps within an adjustable rate mortgage. For example, you might hear like a 215 cap. Well, what do those numbers actually mean? Okay, the first number is the initial adjustment after the fixed period ends. So let's say you're at a 10-1 ARM at 4%, and let's just say the index goes crazy. Well, there's a maximum cap on that first initial adjustment that it could change to. So, for example, let's say you're at 4% and then the index goes crazy. Well, then that first initial adjustment would be at 6%. Now, the second number is for the maximum adjustment every year after the initial adjustment. So like the second number with being a 1 would mean that after that first adjustment, then it could only go to 7% or lower to 5%. And the final number is the lifetime cap. The last number being 5. That means the highest that the interest rate could be it would be at 9%. So you want to make sure that you understand exactly how your interest rate could cap, and you want to make sure that you calculate your payment and can you afford that payment if it goes to the lifetime cap. You want to make sure you understand exactly what you're getting into with an ARM loan. It's okay to call timeout and ask questions. And here's the other thing too, your lender and your realtor is going to be long gone after you start making those payments. So you want to make sure that if you're getting into an ARM loan that you can afford it, because if you get into the wrong type of ARM loan, it could be a disaster. So you want to make sure you're working with a local trusted loan advisor. Don't forget to show some love for the channel. Be sure to subscribe and ring that bell for notifications. And hey, let's check out this video next, and you make it a great day.